Hey guys, Mike Campos here. This is video number 2 of a 2-part series about how to finance real estate with a low down payment. This is low down payment to me are purchase transactions with a less than 20% down payment. And in my first video, I talked about the use of a 10% down payment on jumbo loans. Sales prices between $700,000 and $1.8 million and 10% down. And if you haven't seen that video, feel free to reach out. I'll forward you the link and you can feel free to watch it. In this video today, we're going to talk about traditional mortgages, conventional and government mortgages. Fannie Mae, FHA, Freddie Mac, and also VA or CalVet, depending on which customer you're talking about. So I'm just going to jump onto this board real quick and share some details about some different mortgage options and what credit scores are required per se for these transactions. So on conventional mortgages, you can finance a loan amount up to $417,000 with a minimum of 3% down payment. On that transaction, you have a lot of flexibility for getting a buyer approved. Some transactions allow for the use of roommate income to get that loan approved. If there's an accessory unit, rental income on that accessory unit is a possibility. And of course, you can buy a house or a condo or even a manufactured home as long as it qualifies. The minimum down payment is a 620 credit score, and all of these loans have to receive DU or LP approval from the entities that we're going to lend the money to. We cannot manually underwrite these loans, so there's very few exceptions, but a lot of creativity we can establish to help get these buyers approved for a loan. If the purchase price exceeds $430,000, then they're going to have to start looking at least a 5% down payment, which is considered conventional high balance. Maximum loan amount of $612,000 and change. You have to have at least 5% down payment and a minimum credit score of 640. Now, these two conventional loans have the ability to utilize down payment assistance. So if the home buyer qualifies in the income bracket for the area that they're purchasing in, and the home buyer has a certain number of members in their household, they can qualify up to 5% of the loan amount as a grant from the state of California. There is an additional process to that. It is not just a cut and dry excess money to be given to the home buyer. They have to qualify for that. Please let me know if you'd like more information about it. In fact, I'll probably do a video about it, so stay tuned with regards to that. Now, FHA financing is at a 3.5% down payment. Now, FHA goes up to the maximum loan amount of $612,950, and they only need 3.5% down. So the difference between conforming high balance and an FHA transaction is a small down payment requirement, additional for the conventional loan, but sizably there is less expenses on a monthly basis, and FHA does charge an upfront mortgage insurance premium and conventional financing does not. So if the customer is well qualified, utilizing conventional financing is the ideal situation from them, and plan B is FHA. If the customer has recent credit history derogatories, whether it's a low credit score or foreclosure short sale, that was a little bit more recent, if they've had other blemishes on their application, FHA is our great alternative. They offer a great interest rate, and it's basically a stepping stone from buying the house with a low down payment using FHA, and then 12 months, 2 years down the road, that homeowner's goal is to refinance into a conventional loan to save money in a lot of different ways. Reduce monthly PMI, possibly a lower interest rate, re-amortizing the loan to help drive down the interest rate. Apologize, not the interest rate, but drive down the payment. So there's quite a few options to why that customer will use FHA, and use FHA to get them into the property and as a stepping stone into the end goal, which is a conventional mortgage. All of these loan programs are 30 years fixed, 15 years fixed. We have short-term fixed loans like a 7/1 ARM and a 5/1 ARM, and depending on the customer's plan and circumstances, the ARM products are a great option to consider. They help a homeowner pay down their balance faster, even though the rate is fixed for a short period of time. Now, VA or CalVet loans allow the home buyer to purchase at 100% financing. This is for our active duty military, our active duty reserves, our retired reserves, and our retired active duty. If you are retired, you have to have an honorable discharge, and I help those customers obtain that right documentation. Because this is a VA loan and it's for our service members, Home Services Lending does not charge a processing and underwriting fee to the customer, driving down their cost to acquire the property. At 100% financing, the veteran does have to have at least 2 months post-closing liquidity or 2 months reserve. So they have to have a couple months mortgage payments left over in the bank after close of escrow. On all these transactions, closing costs are negotiable. You can negotiate that the seller pay the closing costs, which may not be the most strategic move in today's market. And we can also pay for these closing costs through the interest rate. By helping a home buyer pay the closing costs, the lender can increase the interest rate, creating excess profit on that loan. And since we're highly regulated to how much profit we make per transaction, that excess profit is then turned around and paid towards the home buyer's closing costs. On VA transactions, you have to remember that Section 1 and Section 2 termite clearance is mandatory. Now, on VA financing, at 100% financing, we can finance up to $612,950 at 100% financing. So if a home buyer that wanted to use the VA financing wanted to do 0% down payment, that would be the max purchase price, $612,950. But VA financing has a maximum loan amount of $1.5 million. Now there's a little tricky formula to how to determine what the down payment would be to lend that much money, but basically, long story short, the home buyer gets 100% financing up to $612,000, and the difference between $612,000 and the sales price, we would then calculate a 25% down payment off that difference, and that would ultimately end up identifying the final loan amount. We can talk more about that at a later time. I have a nice spreadsheet that will help calculate that for the home buyers. With all of these loans, they do have minimum credit scores. You have to have a bankruptcy and a foreclosure and a short sale all seasoned, sometimes between 2 and 4 years old. Depending on the circumstances, will determine how old that foreclosure, short sale, or bankruptcy needs to be. If you or any of your customers have any questions about these loan programs or how to become pre-approved to purchase utilizing these conventional financing options, feel free to reach out direct. Call, text, or email, and I look forward to talking to you soon.